So bad news first. I just want to get that out of the way. I got stopped out of the Euro Aussie. I took a swing on the RBA, got the fill that I wanted. In fact, typically you all know that my approach to a stop loss is relatively, well, I should say very risk tolerant. I'm usually very risk tolerant. I'm willing to put in a mental stop and leave it be. But since this was a 10:30 event and that I was going to be likely asleep within an hour of the event, which I was asleep by, 11:30, 12. I watched the event at 10:30 and got my fill. Before I went to bed, I put a stop in at 75 because really I'm uninterested in taking this market any further than the 80 pip. Now, unfortunately, I got wicked. I caught the wick the wrong side. That low was 24.71. Not that I'd be ahead at this point, but I'd be pretty much even because my entry was 97. I got in right around that 00 during the volatility of the RBA release, which was this candle right back here. So I got in during the volatility of the release. So I'm out. I really normally would be in, but this isn't a normal time of year, really, is it? This is December. I'm not really interested in unraveling my year. I've had a challenging couple of months. The closer we got to the fiscal cliff, the closer we continue to get to the fiscal cliff, the more challenging I think it is. I read an interesting stat about Paul Tudor Jones being up something like 3%. I found that odd, or 3.5% maybe. It was a tweet. I found that oddly comforting, that his 2012 return was pretty bad. Now, I'm not relishing in somebody else's. He's still positive, which is fine. What I mean by that is someone else had a difficult time this year, and I have to say the first 8 months of the year, I really didn't have a difficult time. I traded aggressively through summer. Now is when I get very retrospective on the year. But I can definitely look back on November and even parts of October and say, hey, it was tough. It was tough. So in many ways, I'm not interested in taking a lot of heat because all of a sudden I think, you know what, if I have 3 challenging months in a row, October was a challenge, November was just a disappointment. So if I have 3 in a row, I'm really putting myself in a pretty bad frame of mind to kick off what is a much better time of year to be trading, which is about the second week of January on to about Memorial Day. So why put myself in a bad mood? Why put myself in a place where I'm thinking, the doubt starts creeping in and things like that? So I've been keeping things pretty tight. Give me what I want, move from where I want it to go from, and then I'll hang in there. If not, I'm out. So that's ultimately what happened. So this is where, like I said, caught the wick on the wrong end. So be it. I don't necessarily feel it's going to launch from here. I have a pretty decent little suspicion here that we're going to transition. And remember, would I have taken a more risk-tolerant approach had this been in an uptrend? Probably. Not probably. Definitely. So I had an eye on the Aussie for movement. And in the meanwhile, the U.S. dollar continues to sink. Now, one of the trades we watched was the 60-minute U.S. dollar, which you can actually see I was in and I got out of. So this is the level that I was watching. Got in and out of the Euro-US. And this was just a swing. Now, do I have directional bias? No. Some of you might say, well, Rocky, why did you take the 60 over the 30? And the same thing seems to be applying over and over again, which is I'm noticing when I look at a lot of 60-minute time frames and then triage them against the 30-minute time frames, the reason the 30-minute time frames are losing is just the quality of the wave, right? Versus what I have is a pretty good, much steadier wave. Now, once again, I'm dealing with a situation where most definitely I do not have directional bias, but that 60-minute time frame is that exception time frame. This is that time frame that says if you want to take this time frame based upon the clarity that clarity is better on that 60-minute chart, go for it. And when it is, I do. So in and out. And you'll notice I'm staying pretty nimble. These aren't setups that are requiring a lot of commitment from my part in terms of time. I did a lot of that throughout the year. I did a lot of that this fall. I'm just not interested in it. So I got in, got out. The risk reward wasn't terrible, but it was quick. It just happened quickly, and that was it. One of the benefits from having stayed up kind of late, I have to say. If you'll notice, I want to show you guys the actual entry. I would have loved to have gotten in back here. I would have loved, but you notice this is the 8 to 9 o'clock candle, 7 to 8, 6 to 7, 5 to 6, 4 to 5, right? 3 to 4, 2 to 3. This is the open. 1 to 2. You have midnight, 11, 10. So this is the Asian session back in here where I actually got my fill. Right? But I would have loved to have been a little bit lower. That would have been nicer. But notice I was able to take advantage of the swing zone all the same. You'll notice here I was still able to take advantage of the zone, which is very important to me, without a doubt. So, I mean, if you notice, kind of hung out in this zone for some time. See that? So we hung out in that sweet spot for a little while. But what I was most thrilled about, and I was drawing in this line right here to show you, is really being able to take advantage of the 50 area. So my fill was actually above 50. I believe my fill was 54 or 56. And I was just looking for the 80, and I was looking to get out. So once again, I parked a profit target, I parked a stop loss, and I got out. So unlike the Euro Aussie, where the follow-through, like I said, I caught the wick on the wrong side. And hey, you can catch the wick either way, right? I caught the wick here. Ouch. What's happening, what I was suspecting was potential Aussie weakness to drive this market. Aussie weakness. But actually, the Aussie is re-strengthening. Now, I knew the rate cut was already baked in. But some of the other fundamentals pointing to the Aussie said, hey, this might be a pair that's weak. But actually, what's benefiting the Aussie is the same thing that's benefiting the Euro, which is some more, we're seeing the T's getting crossed and the I's being dotted, and ultimately, we're seeing a positive spin on this continuing Greek story. And essentially, the market's reacting well to it. And one thing to notice, I don't know how many of you read the RBA statement, it was not nearly as dovish as some people thought. There was some expectation that they might cut again. In fact, there was a lot of talk of a second cut yesterday, but I didn't see a lot of indication of that. And if we were talking about it so much, it was probably a pretty good chance that it was, too, potentially baked into the cake. So whether or not you look at the less dovish talk, or the fact that the traders who did discount a second rate cut have to cover that position, your net movement is bullish. The net movement is bullish. Kind of a relief that the RBA is likely not going to cut, and relief that what we have is ultimately a market that is willing to run. Our newly minted IMF reserve currency. So it's not as weak, right? So I'm not getting as much follow through to the upside on the Euro Aussie, because what do we have here? We have a foot race here, don't we? It's a foot race situation here, because we have Euro strength and we have Aussie strength. And that's not unusual in risk on, but that's ultimately what we have here, with a lack of directional bias. So let's get back over to that Euro US. The other pair we were looking at, I'm not going to go over the dollar Swissy BDG because I didn't take any of the BTGs. I didn't take the dollar Swissy BTG from yesterday, and I did not take the dollar yen BTG. The other chart, though, we were looking at that includes the US dollar, since I am talking about the Euro US dollar Swissy, is that dollar yen. And we also looked at the cable. So dollar yen was a 15-minute short. Dollar yen was a 15-minute short. Now I am flat right now. Okay, I am absolutely flat right now. The dollar yen I did not ultimately end up taking. And what's funny is it looked every bit as good as the Euro US, and it was a shorter term time frame. I think because I had the Euro and the Aussie on the brain, the Euro Aussie and the Euro US just felt more sync for me. So I think that's why when it comes to the dollar yen and the cable, I passed. Because I was already in the kind of Euro US, Euro Aussie mindset. And one, you guys know that I like that one mind many markets. I like when things are synced. And two, I don't like the pound sterling. So no surprise there. We looked at the Aussie loonie. And again, I'm just recapping some of the pairs we looked at yesterday because these might be some of the same pairs we look at today. We looked at the loonie. We looked at the 15-minute. We were looking for potential loonie weakness. And that was based on, I believe, an expectation for, if you take a look here, movement lower. But then what have we seen since? Definite loonie weakness. Again, one of the things we made notes of yesterday was the loonie was a laggard in yesterday's early risk on environment. Now, ultimately, we did not end that way. But when risk was on the table, the loonie was not participating. So it was a laggard. So from a relative strength standpoint, when we switched to risk off, the loonie absolutely accelerated and the picture looked even bleaker for it. So when things were looking good and the loonie should strengthen or at least tread some water, it couldn't. So when things get bad, it's definitely going to accelerate to the downside. So I don't know how much of this, and it's tough to tell. It's tough to tell to what degree this is a loonie strength move versus, an Aussie strength move versus loonie weakness, but I think both are contributing because one of the things we made note of was how much the loonie, and we had looked specifically at the dollar loonie as a laggard. So now we're actually looking at that same Aussie loonie, but now potentially along the 15 or 30 minute, we could stay nimble here, even on the 5, for potential between the greens. So we can go ahead and put that on our radar right now to look at as we go through the morning. So Aussie loonie. We also talked about the Aussie Swissy. But remember, with a Euro Aussie, an Aussie Swissy is kind of a similar position, but one thing that made the Aussie Swissy a little dangerous, and I think we talked about it here in the room because one of you shared the news, which was that, and I think it was Caldoun who shared the early yesterday morning fresh rumor of negative interest rates in the Swissy. So since the Swissy had its own little thing going on fundamentally, we could see in this situation the Swissy lose ground and make the Aussie look strong against it, and that's what we've got. This is a weak Swissy here. I don't believe this is a Aussie strength play at all. This is a Swissy weakness play, which then, of course, makes our dollar Swissy, which I did not take, that much more interesting. Yeah, with a zero interest rate, you're going to see any of your Swissy pairs. Jerry, you just mentioned big move in the Euro Swissy. Not a pair that I trade. It was pancaked for the better part of, 16 months? How many months was that thing just flat as a pancake? So the Swissy moved that particular, any of the Swissy charts you look at, it's Swissy weakness. Now what's interesting is you juxtapose a weak US dollar, which we definitely have, to the Swissy, and you look at the dollar Swissy, which we had on our radar yesterday. It was a BTG. We wanted to stay nimble in light of that rumor. But ultimately, the Swissy actually is hanging on because we have a foot race here. Dollar's looking bad. Swissy's looking bad too. So we're really kind of going nowhere here, as both of them are pretty weak. Overall, do we have directional bias? No, but we can see here before the Swiss franc story hit the market, this is a lot of US dollar weakness working in and some Swiss franc strength. So that was the mood the market was in before this hit. So I'm really not interested in this Swiss franc story right now. I don't want to trade it. In fact, I'm not really trading anything against the Swissy. The Aussie Swissy, like I said, didn't look as good as the Euro Aussie and kind of is a very similar position. And the Swissy just made it that much more unattractive because of that zero interest rate story that was running through the market. Okay, finally, as we recap the last two pairs, dollar loonie was on our radar. It was a laggard. But if the loonie is weak and the dollar is weak, who's going to win? Look how ugly these charts look. They hurt even to look at. No clarity here. Not interested. Just moving on. The only pair that we have some pending limit buys waiting in still is this Aussie yen. And this is based upon the directional bias of the daily. So that recaps what we were looking at yesterday. Took a hit in the Euro Aussie. Had a good trade in the Euro US, and the overall look at this market as I look at it this morning is, okay, the Aussie fared much better than expected. And how much of the Aussie strength might be coming from the same thing that seems to be right now pressuring the US dollar and rallying the euro. So let's jump into that. And I do want to keep an eye on this Euro US again because, gosh, I would still love to be long this thing, but ultimately, like I said, the same thing that got me stopped out of that Euro Aussie is the same thing that kind of capped me on this Euro US. So be it. Today's a fresh day. Let's see what we've got.